Namaskar. I am Sharad Kumar Revatkar. I was faculty at Dena Bank and Central Bank's Apex Training College, Sir Soraji Poskanwala Bankers Training College. I was a faculty for around 9 years, and during my faculty period, I have compiled 3 books on promotions, and these books were remained useful from 2001 to 2011 for all levels, means you can say from clerical to scale 1 to scale 7. Many of my students, you can say, they became general managers. So friend, in this second YouTube, I am going to tell you about the Basel Accord, but mainly why Basel Accord is implemented, as a Basel I. So friends, what is this Basel Accord? As I told you, Basel Accords are the set of international banking regulation developed by Basel Committee on Banking Supervision. This Basel country initially consists of representatives from G10 countries, means these countries which are having a significant economic impact on the global economy, and these countries are Belgium, Canada, France, Germany, Italy, Japan, Netherlands, Sweden, Switzerland, United Kingdom and United States. Friends, all these countries have a significant economic and financial influence globally. And to make it more global, another countries are added, and they are Australia, Brazil, China, India, Indonesia, Mexico, Russia, Saudi Arabia, South Africa, South Korea, and your Turkey. Friend, why Basel? In my first one, I told you the banks is an intermediary. While doing this role of intermediary, that is acceptance of deposit for the purpose of lending and investment, banks are facing several problems of becoming failure. And to safeguard the interest of the depositor, or you can say to safeguard the interest of the stakeholders. Now, who are these stakeholders? They are financial economy, Government of India, Reserve Bank of India, depositors, shareholders, etc. Now, the key objectives of this Basel is to strengthen bank capital requirements. And why for? As I told you, to address the risk. Ensure banks have sufficient capital to absorb potential losses incurring out of several risks like credit risk, market risk, operational risk, your interest rate risk, your off-balance sheet risk, your systemic risk, your technology risk. Then second is improve risk management. Same thing, ensure banks' ability to manage and mitigate various risks. Then increase transparency and disclosure. Increase transparency and disclosure means to promote transparency in banks for financial reporting and risk management practices. Reasons for implementing Basel norms, one and the same thing, financial stability. Enhance the stability of the financial system by reduce the risk of bank failures. risk-based capital requirement. Banks have to align capital requirement with the basis of the risk taken by banks. Level playing field. Create a standardized framework for promoting fair competition. Friend, Basel I Accord is implemented in 1988, and the benefits of Basel norms are reduce the risk of bank failures, naturally strengthen the capital requirements, and improve risk management to reduce the likelihood of bank failures. Then increase the confidence in the financial system. Banks have enhanced transparency and disclosure to promote trust among stakeholders. And I told you, who are the stakeholders? The stakeholders are your shareholders, your Reserve Bank of India, your Government of India, your economy, your society in general, and the depositor in particular. Improve bank resilience. Now, first thing is, what is resilience? Resilience means the capacity to address the awkward position, to awkward the critical situation, and to come out of that critical situation. That is known as resilience, ability to address such critical problem. So improve bank resilience. Banks are better equipped to withstand economic downturns and adverse events. Now we will discuss what is this Basel implemented in 1988 and the difference between Basel I and Basel II. In Basel I, capital adequacy ratio was kept only 8%. And in Basel I, only one risk was addressed, that is a credit risk. They did not take care of the operational risk, did not take care of market risks. And these risk categories are categorized into 5: 0%, 10%, 20%, 50%, and 100%. 0% means the bank is having cash or deposit of central bank, will carry 0 risk. Interbank deposit will carry 10% risk. Mortgages, loan given for the mortgages, that will be 20%. Other loans 50%, and the loans given to the corporate, they will carry 100% risk. And no explicit operational risk requirement in Basel I. Now, in Basel II, which is implemented in 2004, risk-based capital requirements, more sophisticated approach, considering credit risk, market risk, and operational risk. In Basel I, they only they only take care of the credit risk. In Basel II, 3 pillars. Minimum capital requirement for what? To absorb various risks. Then supervisory review process, regulatory monitoring and guidance, market disclosure to ensure transparency. Market disclosure to ensure transparency. And what is this ensure transparency? To promote transparency in banks' financial reporting and risk management practices. Standardized approach. Introduce a standardized approach to credit risk, allowing banks to use external credit risk. allowing bank to use external credit ratings. Then internal ratings based approach allow bank to use their own internal credit risk models. Operational risk requirement introduce explicit requirement of the capital to address operational risk. We will be repeating here Basel II 2004 risk-based capital requirements. As I told you, in Basel I, they address only credit risk. But in Basel II, they addressed more sophisticated approach for calculating capital requirement, taking into account credit risk, market risk, and operational risk. In Basel II, as discussed in the earlier this one, three pillars. Basel II introduced the three pillars: minimum capital requirement to absorb risk, supervisory review, regulatory monitoring and guidance, market discipline to ensure transparency, credit risk, introduce a standardized approach to credit risk, allowing bank to use external credit rating. Market risk, introduce a standardized approach to market risk, capital requirements for interest rate risk and equity risk. Thank you, sir. And my dear viewers, in third one, once again we will discuss Basel II and then Basel III and the difference between Basel II and Basel III. So thank you very much, and I hope you are getting updated with this information on Basel Accords, international banking regulations developed by Basel Committee on Banking Supervision. And when you are watching my YouTube video, please like it, please subscribe it. Thank you very much.